guys just said bad things. Okay, anyway, I wouldn't have done that. I think you're right with. No, anyway. I wish we would get our act together a bit on those things. When we had Audrey Gramling here, she didn't realize how important it was at first. She's changing a whole bunch of stuff. She was asking me for my assistance with a bunch of things and get it done before. And I just said, this is going to bite me. Come back and bite you. And then after a while, she really asked for my advice and took it. You know what I mean? So and we got to be careful. All that stuff. But anyway, okay. So what we were doing Nordstrom's. So this is quiz, the WAC quiz we did for those of you at home. All right. And we valued Nordstrom's. So we'll run through how to do this. Some folks had some trouble with it. Some folks had none. It's all over the map. But anyway, what pieces of information do you need? The way I do it is I just say, what do I need? And I go find it. What do you need to do WAC CAPM?
Or estimated cash flows or in WAC.
Yeah, estimated cash flows in WAC. That's it, right? Because we're just going to do the estimated cash flows. We're going to divide it by the weighted average cost of capital. The estimated cash flows are the cash flows we think we're going to have forever. So we're no growth, up or down. I'm very quick. Yeah.
Now you can turn the screen on.
Oh, you want the screen on?
Oh, yeah.
Yeah, sorry about that. The folks who are here actually want to watch it on the screen. I don't understand that either. It's probably coming down. Mean volume off, mic volume all the way up. That looks good. Okay. Anyway, is that warming up? Is it? Hey, the sun came up a little bit out there. That's nice. Okay. Anyway, so estimated cash flows divided by WAC is what?
Estimated market value assets.
Estimated market value of the assets, and this is our own independent estimate, right?
Yeah.
Okay. So it's not the market's estimate. We already know what the market's estimate is. It's the market cap plus the liabilities, right? Yeah. So we know what theirs is. And then we would subtract from that our estimated market value of our liabilities, right? Yeah, and the reason we're using the ending liabilities is we think that's a pretty good proxy for the market value of the liabilities. We're not really using book value, right? So if you think the market value of the liabilities are significantly different than the book value, you should calculate that. If it's bonds that are being publicly traded, you can look up what the value is and use it, right? If it's mortgages, you can look at what interest rates are now compared to what they were when you got the mortgage, right? They go up and down. You could value that mortgage. There's gains and losses on debt when interest rates change, right? Okay, so that'd be the deal. And so then this is so we are going to use book value as a proxy for that. Then we're going to have estimated market value of course, equity, your assets less your liabilities for your equity. All that. And you're going to divide that by number of outstanding shares, right, guys? And this is just not a big deal. It's intuitively obvious almost after a while. And then the difference is what? Or the division is what? Obviously, market value per share. Huh? So that's the world we work in, and we want to get all of this stuff. So what you need is the estimated cash flows, no WAC, exactly where you guys started. So if you know what those are, you got it made. So how do we get the estimated cash flows? I'd ask you this, did you guys use your notes when you did this, or you just do it? Did you use that handout I gave you, or you just do it? You just did it, didn't you? You don't even hand out if you know what you're doing. Okay, I mean, it's fine, it's there, it makes you feel comfortable.
It might get take longer, probably.
Yeah, maybe, yeah. But,
People are
oh, we're looking back and forth, are you driving you crazy? Yeah, I would never look at it. Estimated cash flows is what? It's the income before tax that you expect to continue into the future. So it's your normal revenues and gains, less your normal expenses and losses, right? So if there's something that's unusual, leave it out. If it's unusual or infrequent, right? Then non-operating, that's where it usually is, reorganization costs or something. So then leave it out. If not, you just use their income before tax, right? So this is going to be net income before tax, but that's going to be net income before tax that is normal, is the way to think about it, right? Okay, so normal. And they say operating income, and the idea and the theory is finance guys say, oh, well, the non-operating stuff is non-operating, so it's not really part of operations, so it shouldn't be valued. I kind of disagree with that, because if you have it every year, you have it every year, right? Going into the future. And by the way, finance people really know what they're doing, would agree with that, you know, and they really want things that are going to continue into the future, right? Okay, so revenues less expenses that are going to continue to the future, basically. And then we take that times what? 1 minus tax rate, right, guys? Because the government's going to pick up 40%, well, I'm sorry, assuming our tax rate is 40% or 38 or whatever it is, the government's going to pick up that portion, right, of all your expenses, and they're going to take away that portion of all your revenues, right? So your income is going to be reduced by the tax rate. So what do we get to keep? It's 1 minus the tax rate. That's all it is. Okay, when you first write this down, when you first read it in the paper, it's kind of like, oh, wow. And then after a while, sold. Okay, and then what do we want to add to it? Depreciation and amortization. Okay, now here's the deal with depreciation and amortization. It's not that it generates cash, right? Journal entry is debit depreciation expense, credit accumulated depreciation, debit amortization expense, and credit the asset that you're amortizing, right? Okay, but when you're coming up with this net income before tax, you have deducted the depreciation because you get to write it off against your income for tax purposes. So let's say that I have $100,000 of depreciation and I'm in a 40% tax bracket. What happens? I subtract the 100 from my income even though it didn't use any cash. Well, then I'm going to have to add it back when I'm done. Does that make sense? Just from that perspective. But the reason I want to do it this way, I want to subtract it in getting the net income before tax over here, and then I want to add it back on the other side. The reason I'm doing that is I get a tax break for it. If I'm in a 40% tax bracket and I put 100,000 more expense on my income statement, what happens? It saves me 40,000 in taxes, right? That's it. Any additional expense you have saves you whatever your tax rate is, right? Times that in taxes. Any additional revenue or gain you have, just the opposite, right? Government's going to take part of it. Okay? So what's going to be the net effect of having 100,000 of depreciation if I'm in a 40% tax bracket? I am going to save $40,000 of cash. I'm going to have 40,000 more cash than if I had not had the depreciation, right? Because the depreciation itself used no cash. So it looks funny to leave it in and then take it out, but that's what we're doing. Okay? But do all of you guys have this? Does this just make intuitive sense to you why we're doing this? You know, you could do it a different way, by the way. You could leave it out, calculate it, and then add back the tax benefit, which is fine. Right? Some models look like, you know, the way they write it looks like that. Right? You do net income, not including the depreciation, right? You take the tax on that, and you'd add back the savings you had from having the depreciation. You get it exactly the same point. David, this is probably the easiest way, I don't know, most intuitive perhaps. Okay, so that's what estimated cash flows are. So then we need WAP, don't we? Right? This isn't going to be too bad. Oh, so what numbers do we need, by the way, out of financial statements to get this?
Tax expense.
Yeah, we're going to get the tax rate, and for the tax rate, what will you do? Maybe tax expense
Over the operating.
divided by that normal net income before tax, or just for the year, net income before tax, not normal, I guess. For the year. And you could do all 3 years, couldn't you? If it's a publicly traded company, you could look at all 3 of them, probably would. And then where else do they have that percentage? This is going to be the percentage tax rate, right? So that's like that guy right there.
The notes.
The notes, they actually calculate it for you. You can look them up. You can look at 3 years. And also, then they show you what the differences are. Right? On this particular company, if you just took the current year, what was it, 39.2%? And if you went back, I think it was, and if you looked at all 3 of them, I thought it was more like 38.8%, which means absolutely nothing. It's so close. It wouldn't make any difference. But, you know, if you looked at the note, you could see what's really going on. Okay? All right. Anyway. So, and then what else do you need here?
Depreciation expense.
You need the depreciation. Where are we going to get that?
Cash flow statement.
Yeah. So the tax and the net income before tax are, both of those, right, are going to be on the income statement, and this is going to be on the cash flow statement, right? So we just go there and grab them. So what I did when I was doing this is I just went and got them, wrote them down, boom, plug it in my spreadsheet in my case, and I've got it. So that's it. I mean, you're only looking for 1, 2, 3, and probably 4 things, right? And then continuing income could be different, okay? So we're looking at the income statement and the cash flow statement. All right, and so then we just need WACC. And again, this is the earnings that you must have as a percent of your assets, weighted average cost of capital. Your total capital is your assets, right? Debt plus equity is really your total capital, total amount you have to invest, okay? This is the amount that you need to earn in your assets to keep both the debt holders and the equity holders happy. The equity holders earn cap M, right? If you earn this amount on your assets, and the debt holders will get paid their interest, but you'll also get your tax savings from the government on the interest, right? Because your interest goes on the tax return too. So what's the formula for WACC?
Weighted debt times the cost of the debt.
Yeah.
Plus-
You know, if you think about that, the debt times the cost of the debt, all you're getting is the proportion of the debt times its cost, huh? That's it. Plus what?
Weighted equity times cost of equity.
Yeah, which is really simple. All right, and then all you have to do is you have to know what you're going to use as proxies for the weights, I guess, and as proxies for the costs. What do we do for the cost of the debt?
It's the interest rate.
Okay,
Times 1 minus the tax rate.
yeah, 1 minus the tax rate. And here's the deal, this tax rate is exactly the same tax rate that we have up here, right? Once you calculate it, you know it, we use different tax rates, of course, right? Okay, and what are we going to do for the interest rate?
Interest expense divided by average debt, or average liability.
Yeah, I like to use average debt. And you can either use all the debt, or you can just use the interest-bearing debt. If you use the interest-bearing debt, you use that for your weights too, right? If you use all the debt for your interest rate, then you use all the debt for your weights. If you use just the interest-bearing debt, use it in both places too, right? Because obviously, if you just use the interest-bearing debt, you're going to have higher interest rate, but you're going to have a lower weight. Make sense? Yeah. So because most companies have a lot of non-interest-bearing debt. What are those things? Accounts payable, accrued liabilities. What else? Deferred income taxes is a big one, right? There could be others, right?
So why would you use one or the other? Like,
What I like to do if I'm doing it for real is do it both ways to see if one estimate is better than the other. Okay. And if they come up about the same, I'm real cool. Does that make sense?
so for this, just pick one.
Yeah, just pick one. But if you want to get a little more sophisticated with it, you might try it both ways. You know, I don't do that on a quiz or test. You don't do that on a quiz or test. Yeah, makes it easier for me to grade too. No, I can figure it out if you did that. Or you write that if you did it, if you like that. I have students do that. So you get a lot more sophisticated with this as time goes on. You start taking finance classes, right? Because who's a finance and double major, even you're in trouble. Just you. Okay, so if you guys decided to do that. And you will get more in the finance class, or if you do, when you do the MBA, we do a whole bunch of it in the finance part of the MBA too, if you're doing the MBA.
What's your opinion? Do the double major in finance or the MBA?
If you are absolutely in love with this analytical stuff, and you love all the number crunching, you just can't get enough of it, I would do finance and accounting. If you like the theoretical, broad view of things, you can put econ with accounting. Are you doing all three? You're a crazy person. You know, you get to study the whole world then. You know, but it makes your college career overwhelming. You know, the others are bad enough. And if you want to do the accounting and then add a broad look at business and exposure to a whole bunch of different types of people of all different ages and all different career backgrounds and all that, then the MBA is a fantastic way to go. So my answer to your question is, what do you like? What do you want to do? And you don't have to make that decision until you are, starting your junior year. You don't want to take any of those classes that double count the MBA and the accounting, right? Or the MBA and for the accounting degree and for the MBA, I said, there are 6 classes where if you took them at undergrad, you don't get to double count the one from the MBA. So you don't want to take any of those. So look, we need to be careful with advising them. Okay, but otherwise, just go for it. See what you like. Okay? You find out, I think, when you get into your finance classes. People find out they like accounting when they get in this class. And then you're not going to do it. And then they find out if they're going to do finance when they start doing the upper division finance classes. And the same with econ. When you get into econ and metrics type stuff, you find out if you're going to do this or not. And into intermediate macro to micro. Okay, so anyway, that's where we're going to get it. Where do you get the interest expense? It's on the income statement, almost always. If not, it's in the notes somewhere. You can find it, right? Or on some supporting schedule. Sometimes it's a pay. Where are you going to find the average debt? Balance sheet, because we're using right? We're using as a proxy for the debt, the numbers on the balance sheet, right? The book value. So yeah, we can find those really easy. So we know where to get those, don't we? Okay, so this isn't a big deal. What are you going to use for KE? Cost equity.
Plus beta.
It's this model called CAPM, which is risk-free. Which everybody gets risk-free, right? That's a true return, 2-3% maybe, plus rent of your money, real return, true return, nominal return, plus expected inflation, right? And what do we use for risk-free as a proxy for it?
30-year.
Yeah, I like 30-year T-bonds, so that's what you guys get to use in here. Other people like different things, right? Shorter periods. Okay. So some people look at the investment horizon. I think you're buying all the dividends and the increase or decrease in market value forever. Right? So I like the longest we have. It's the longest measure we have of risk-free. Okay, so good. And you said plus the beta. Okay, and the beta is what? Where would we find that? Where would we find these, by the way?
Looked at Yahoo.
You could get it at Yahoo Finance. You could get it at, I don't know, Microsoft Finance. You could get it at Google Finance. Right? There's all kinds of different ones. Okay, so value line if you want to pay for it, pay for the service. Okay, so yeah, sure, we can find that, and that's exactly where you're going to find the beta too, right? What's the beta going to be? It is, and by the way, if you look at Yahoo Finance and MS Finance, you'll find different betas because they use different periods of time, right? Different methods of calculating a little bit. So sometimes it's a good idea to look up several of them, right? See what you think. Anyway, usually they're the same, but sometimes they're just really way off, different. And I don't mean the calculator wrong or anything, just different periods and stuff's going on with the stock price. Okay, so that's going to be the beta, and it represents what? The variability of your stock's return, this stock, right, that you're analyzing, relative to the market as a whole, right? Use the S&P 500 or something like that. They'll have it against, right? Okay? So your beta is supposed to be a proxy for your, it is the fluctuation of your returns compared to the market returns, right? Covariation of the returns, your returns to market returns. But it's supposed to be a proxy for how risky you are. And I think that intuitively that makes some good sense. If you're going way above and way below what the market does, what if you have to sell it in short notice? And you're way below, you're going to take a hit, right? Versus if the variability is very little, then it's never going to be down very much, but it's also never going to be up very much. So anyway, that's the deal. Okay, so it's sort of a proxy for risk. Okay, good. And time to what?
Risk premium?
Yeah, this is the risk premium. Okay, and the risk premium is composed of what, guys?
The return on market.
Yeah.
Minus the risk-free.
The risk-free. And this will be the same risk-free here and here, of course, right? So what's the beta of the market, by the way? 1.0. So the beta of the market is 1. So CAPM for the market is return on the market, right? Of course. Okay? And what we do is we separate the risk-free part out from the risk premium part, right? Because for each specific company, they don't get more risk-free. Right now the risk-free is around 3%. Everybody gets 3% risk-free, right? But if your beta is 1, you're going to get the risk premium the same as the market does. If your beta is 2, you're going to get twice as much as the market does, right? Well, okay, so and I broke something. Oh, it's gone down the hole. I don't know. It wouldn't release and then it did. Stapler. Anyway, so everybody got the idea that the risk premium is return on the market less the risk free. On all these quizzes and tests, what did I give you on this one? I gave you a return on the market, didn't I? So I gave you the 10%. And then you look at the risk premiums around 3, so what does that make the risk premium approximately? 7. What if I gave you a risk premium instead? If I said risk premium is, I don't know, 6. And add it to the risk free of 3 to get the return on the market, right? then 9, I guess it'd be. Okay, so you gotta know what the difference is between each of these things, okay? Where do you find the return on the market? I have to give it to you. In real life, what do you think the market's gonna do forever? Right, what do you think's gonna happen? For me, it's 12, 13%, because that's what it's been over my lifetime. Okay, since I was 30 when I started investing, for the last 35 years. Okay? Then 12 to 13, I think it probably will be. But inflation used to be higher too. So right now, I think maybe a reasonable expectation for a return might be 9 or 10%. Why? Because risk-free is only 3. What if risk-free goes up to 6? Which means expected inflation goes up to 3, right? Get the idea? 3 to 4. If that happens, what's going to happen? Well, the return on the market has to go up, doesn't it? Everybody's going to want more, because they're going to want what? Rent of their money, 2 to 3%, right? Plus, they're going to want expected inflation. So they're going to want a risk premium of still the same amount, 6, 7% maybe, 5, 6, 7, 8%. But you're going to add it to more risk-free, right, to get the return on the market. So if the risk-free goes up to 6, of course, everything's going up. You need 12, 13, 14 then, somewhere in there. You guys all staying with me on that? Okay. So with inflation, when inflation fires up, the risk-free goes up and everything goes up, right? What is the bond prices, by the way? This means their interest rates are fixed in the bond. All the interest rates go up with inflation. What happens? Bottom falls out on the bond market. Everything goes down in value, right? Okay, so when you invest in the bond market, you're betting on not having inflation. Suppose it's easier for the stock market to adjust than the bond market to adjust it. Well, that's not true. The bond market adjusts really fast too. It's just if you're holding it, you're holding it. Right? So a lot of people think the bond market's not risky. No, it's just less risk. Why is the bond market less risk than the stock market? Well, the treasury bonds, that's true. They're very low risk. The government will pay those off. Treasury bills and treasury bonds, when you invest with the federal government, they're going to pay, right? They're not going to destroy their credit rating. But even bonds for companies are less risk than stock. That's a good answer. Even company bonds are less risky than the stock side. It's debt. Declare bankruptcy and liquidate. Sell all your assets. What do? You pay off first the employees, then the government, right? You owe taxes, and then who gets it? Secured investors. Guess what bondholders are? Secured investors. Who's going to get paid later? Way at the end. Common shareholders. Yeah. So obviously bonds are going to give you less return than stock, less expected return. Why? Less risky. That's it. If I have a big chance of losing my money, I want really nice return, right? That's why casinos have to pay off so much. Yeah. Negative net present value investments. If you invest in a casino, right? It's not investing, it's keeping your money. Racetrack, whatever. Okay, good. So what else do we need? The weights? How do we get our weights, guys? What do you want to do for weights? Weights are going to just be what percentage of the total assets or liabilities and how much is equity? Okay, what did we say we were going to use? Do I know, by the way, the market value of the assets? No. I'm not going to appraise everything. That'd be ridiculous anyway. You're not going to do that. In any size company at all, it'd be ridiculous. For your personal assets, it'd be ridiculous. Appraise everything and try to find out what they're worth. What's a better way? Add up your liabilities plus your equity. What do we use as a proxy? I already said this. What do we use as a proxy for the market value? Yeah. Okay. Is the book value. Okay. So it's really important that you know that that's not what we think, right? That we're not using book value in this formula. It's market. Everything's market. Okay. And that'll help you remember that this has to be market value. How did I get the market value of the equity? That's it. This is what the market, but by the way, this is circular reasoning here, so it's a flaw in the model. We're using the market's estimate to come up with our estimate, but it still sort of works. Okay, so it does work. Number of outstanding shares times the market value per share. This is what the market thinks it's worth, not what I think it's worth, right? I'm going to come up with my own estimate. And we call that what, by the way? You look it up on Yahoo Finance.
Market cap.
Market cap. Okay. So where will you find So that's all it's gonna be. Get the total for each and then get the percentage, right? That's it, okay? So you get your total, market capitalization, and you get your total liabilities, and you add the two together, and that's gonna give you your total assets. The assets are 100% of themselves, right? And then divide the assets into each one of them. And you got your percentages, they have to add up to 100%. The biggest mistake people make, it seems like, is they'll grab book values for both of these, and everything goes nuts. That doesn't make any sense. When you invest in stock, you do not pay its book value. You pay its market value. True. Everything's out there. All right. Okay. And where are we going to find all these things? Book value, where's it going to be?
Balance sheet.
Balance sheet, sure. Same balance sheet that we used up here to get the average debt, that'll just be the ending debt, okay? And then what else? Where are you going to get these outstanding shares and the market value per share? Yahoo Finance. And so if you know that, or wherever you're going, whichever server you want to go to, okay, if you know that, you got to make. So it's really pretty easy to get these things, and then just calculate it out, okay? So let's do it for this company, which you guys did. I bet you that you went Google search. I bet you put in Yahoo Finance, did you? Go in there. All right, so for the benefit of folks at home that may have a little trouble with this, maybe, I don't know, some of you guys might have, I don't know what your scores are. What do you want to do?
Market data.
Market data. If I do market data, there's bonds. Isn't that lovely? Or you just click on market data, it all comes up. What do you want? 30-year? And the yield is today now, right? So it's 2.84. I think when you did this, it was 2.85, wasn't it?
Yeah. So
let's use, I don't know, we use 2.85, okay? Everybody good? There it is. It's 2.85. I'm gonna write that down. Yeah. So we keep them. Okay, we're gonna use that. We're gonna plug it in there. That's all there is to this. What do you want to do next? Doesn't matter, but we're here. What else could we do? I'm boring you to tears. I know you're in class. See you later. Okay, what do you want to do?
the number of outstanding shares.
Yeah, okay, so where could we go? We want market value and outstanding shares, so we could, I just clicked over here for quotes, we can type in their name, can't we? Or if you know their code, used to be you had to know the code, it was really annoying. Now you can just type in their name, much more user-friendly. These sites have really improved over the years. This is fairly new stuff that we had, well, the internet's fairly new stuff, really. So that, but having this much out there is really, really nice. It used to be a real pain to get this information. All right, so we're going to use the 30-year 2.84, and then we're going to type in the company, huh? It was Nordstrom's, right? There it is, Nordstrom's Inc., right? Okay, so we click on Nordstrom's Inc., and voila, it comes. So what's our market price right now? 64.05. What was it the day we did it?
65.23.
Okay, let's use 65.23. Gone down 6 cents. So this is just a picture of where you're at, right? We'll use what it was on that day so we get the, same answer, I guess. Okay, then what do we want to know? Beta? Right? Yeah. Is the beta here? Yeah, there it is, 0.913535. They haven't changed that, they haven't had time. Right? It's been recalculated yet. That's fine. So 0.91 is good enough, or 0.914 or something, but I used it all. It doesn't make any difference, okay? All right? Okay, so we've got that. What else do we need?
Outstanding numbers.
Yeah, and market cap, don't we? Now, market cap's here, 12.06 billion. That's there. But the number of shares are not here, right? You have to go where? More statistics. Key statistics. There we go. Ta-da. All right, you just get so you can navigate around in these things. It's not a very big deal. Okay, there's market cap, 12.08 billion. Okay, the price is 64.16 at that point today. Okay, and it's constantly changing, of course. And then the outstanding shares, there's beta again, 0.91, but I like the one that has more decimal places, don't you? So I'd use that. Not that it'll make much difference. There's the shares outstanding, 188.23. Is that the same as we had? 188.23.
Yeah.
Yeah. Okay, so we got 188.23. Take 188.23 times the market value per share we had at that date, and that'll give you the market cap we had at that date. You guys might have that written down anyway, huh? But that's how you do it, okay? The way they get this market cap is they take the price per share times the outstanding shares. So here's outstanding shares, 188.23 million, right? We take that times 6416, and that is the market cap here of 12.08. But don't just get the market cap, you need the number of shares for later when you're going to divide it in, right? To get your estimate. You got to have that. You got to have all those numbers. And of course you want the 6416 in this case, for whatever the value was the day we did it, the other day, right? Because you're going to compare that to your estimate, see if your estimate's higher or lower, okay? All right. So is that everything we need out of Yahoo? There's not much, is there? How many things was that? 1, 2, 3, 4, 5. Yeah. I wrote down just on the corner there. I had it, right? When I worked it. Of course, I had my spreadsheet open and plug it into your computer. You guys have your formulas. All right, so then where do you want to go? To financial statements. My recommendation is not to use the ones that are here. Now, there are statements here. See this? Income statement, balance sheet, cash flow. They might be fine. They might not, right? They might have screwed up, okay? So, way too often, they summarize things in a weird way. You can't tell what's continuing and what's not going to continue. So what I like to do, personal preference, is I actually go to the financial statements for the company. So how would we do that?
Your website?
Go to their website, you bet. So I'd go back to Yahoo and just start over, right? Okay? Because otherwise it's going to take you back to that site again. Okay, so we put in Nordstrom's. And they're going to try to sell us clothes. Right? But here's their official site, Shop Nordstrom's. Lovely. Okay, so we get on there. And they're not very interested in us being investors. They're interested in us buying stuff from them, of course, because they're a retailer. If it's not a retailer, you can find the investing area a lot easier. But it's always here. They just bury it down at the bottom of all their ads and everything. Some pretty girls. Okay, anyway, so what do we got?
On the right.
Investor relations right there. There are other ways to find it too, and whatever you see first. Okay, so now we're in investor relations, and what do we want to do? Maybe financial reports or SEC filings. Going to be one or the other probably. Okay, here we've got a 2014 annual report and a 2014 Form 10K. Those are the same thing, aren't they? For some reason, our computers in classrooms, the PDFs don't open very well, so we'll use them. I think this was the one that opened easier. Is that what you guys found too? Or they both opened? Okay. Sorry.
I think this one, like the print was small though.
Yeah, so the other one's nicer.
PDF, I think.
If you could get into it. I don't know if it'll let me or not.
That is.
No, this is HTML.
ML.
Yeah, thank you.
What's the PDF thing? Scroll down.
PDF on the top.
It's to the left of the.
Oh, there it is. Okay, so the PDF version. Okay, let's see. There it goes. It's loading. Maybe we're just having some problems with the system too when I tried to do it. Half the time I can't get my emails in the mail this week for some reason. So is this going to be a little easier to see? Yeah. An error exists on the page, not displayed correctly. Contact somebody. Lovely. Yeah, it didn't work. Okay. Did this happen to you guys while you were trying to do this?
Just click open it.
There it goes. Now it's working. Yeah, there it goes. Okay. Yeah. Okay, so now what do you do? How do you find things?
That's how to scroll.
You mean you just scroll down until you got there?
Yeah, I mean, I knew it was towards the bottom.
Yeah, you're at least half the way down. And you get kind of used to these things. It's probably down in, well, here's page 50 out of 96, right? So if we keep going, oh, look at that, there's notes. I'm past the statements now. As soon as I see notes, we know we're past. So it's usually right around 50 on a really big company. That's funny, isn't it? But it could be 30 or whatever. About halfway down anyway. I went too far. Notes. There's this so long. want to guess, what's this? It's like a cash flow statement. What do you want to pick up off the cash flow statement? Depreciation. It's always there. So it's 508. There it is. Depreciation, amortization. Jump right at it. You know where depreciation, amortization goes on a cash flow statement. It's right after net income. So that's easy. Okay, and then I guess that net income is going to be over in the income statement. So we wrote that down, 508. And then what do we want to find off the balance sheet? What do you want, guys? This is going to be comprehensive earnings. Oh, it's the end. Here it is. Or that actually that was equity statement, wasn't it? We don't need anything there. What do we want here? Total liabilities, beginning and end, right? Of the balance sheet. Everybody agree? We're on a balance sheet here. What I would do is I take usually I take the total liabilities plus equity and subtract the equity. And the reason I do that is they might have the current and the non-current separate and not add the two together and tell you the total liabilities. Do they have a line here for total liabilities? Nope. And what some people did was they just took the current liabilities, and what a couple did. And a couple of other people just took the long-term liabilities. And neither one's going to work very well. If you want only interest-bearing, which ones would you pick if you were only going to do the interest-bearing? Current portion of long-term debt is only 8 there, right? And then long-term debt is 3,123, and I think everything else is non-interest-bearing. So I get 3,131. Yeah, I guess. Okay, if I add those two together. But I think what you probably ought to do is use all of them. So what do you get if you take 9245 and subtract 2440? That's the ending liabilities, right? Write that one down. How much is that? 6805. Okay. All right. And then we want the beginning so we can get the average too, right? So let's take 8574, take away 2080. What do we have there?
Take away what?
What I'm doing is I'm taking my total liabilities and equity less my equity, and that gives me my liabilities, right? So 8574 here is the total liabilities and equity, beginning of the year, and take 2080 away from that, and that's my liabilities at the beginning of the year. So it looks like the liabilities went up some, didn't they, during the year? What was the beginning? 6494. Okay, so we've got that now, right? What else do we need? We got the equity, we got the debt. What else do we need? Yeah, we have to get that continuing income, and we need taxes, and we need interest, don't we? So we're getting there. We're getting there real fast. There's comprehensive income statement, okay? So here we go. Here's our income statement. Now what I want to do here is I want to look and see what's going to continue in the future and what's going to be different. So I'd glance across each of these sales. It just looks like it's increasing year to year. It's not bouncing all over the place. It looks pretty normal. Credit card revenues gradually increasing. Looks pretty normal. So revenues are okay. Costs and related buying and occupancy costs, what do you think? Cost of sales? That's their product. That looks pretty good. Selling, general, administrative, it all looks pretty normal, doesn't it? Interest expense, oh, I'm going to use that interest expense. I'll write down the 138, right? So there it is. Write down your interest expense. And then earnings before taxes. It all looks pretty normal, doesn't it, year by year? In fact, we're even making the same amount of money every year. Okay? So this was a pretty simple one to do. You're welcome. Okay? But anyway, income tax, there we go, right? So what could we do now with the income tax? We could calculate what the tax rate is each time. What's 465 divided by 1185? 39.2. Do the year before. 455 divided by 1189. Now, I like to print these out, by the way, if I'm doing it. Right? Did you guys do that? I just printed it and had it sitting there. Although that's kind of hard to do, was doing it a lot. How much is it?
38.2.
Yeah, these are pretty constant, don't they? There's a little difference, right? And then what's the last one? 450. The earliest year there. It's 14, 13. How much was it?
38.
So what rate did you use?
I used 39.
The current one? Yeah. Be careful. What if the current one was 24% for some reason? Something happened, right? They have a loss carry forward, or something's going on, right? So you want normal. It's what the tax rate's going to be forever, right? So I think for this company, somewhere around 39 is pretty good, don't you? Okay. What could we also do for tax? We go to the note on income taxes and find out what's going on. So what if one of the years is 24%? You could go there and you could find out why, what happened, and see whether you think it's continuing into the future or not. Okay? So anyway, this one's not too bad. What are you going to use for your cash flow? Normal income before taxes. Yes, 1185, huh? Whoops, I guess. Yeah, 1185. That's right. This line right here. I guess that, right? 1185 there. Because that looks pretty normal every year. I'd use that. What are you going to use for your tax rate? I guess, yeah, I don't care. 39.2 is fine. 39% is okay. Okay, I use 38.8 for some reason. I'll show you that in a minute. Didn't make any difference. Okay, so now what else do we need? The piece I didn't pick up yet. I didn't know. I take it back. I got the interest, didn't I? What are we going to use this interest for? The 138.
Right.
We're going to take that and divide it by the average debt. We've already got the average debt, don't we? So we're ready to go, aren't we? Okay, let's go down and let's look at the notes. Anybody know what note the tax note was? Okay, there's property, plant, and equipment, self-insurance, they insure themselves, big company, pensions, debt. Oh, here's another way you can get interest rates. Look at all these interest rates right here. These are their normal interest rates, right? This is what they have. Here's their mortgage. Here, look at these. Their Class A notes are only 2.28%. These guys have good credit, don't they? Right? And look how much it is. The secured debt, really low interest rate. Here's their mortgage, which is not very big. And then here's a bunch of senior notes, unsecured debt, 6% down to, well, I guess it's 4% up to 7%, right? So an idea of what their interest rate is. If you're using their interest-bearing debt, it should be in there somewhere with those. Yeah. So there's lots of information here. Here's interest expense. If you couldn't find the interest, in fact, we shouldn't use the 138. We should probably use the 156, shouldn't we? That's the real interest. The 138 is fine. It's going to be close enough, right? They gave you more detail, didn't they? Okay. So if I was doing it in real time, of course, I'd go look at that kind of thing. Fair value measures, leases. Look at all this stuff that's out there. Did I go past the tax note? Found it when I was doing it before. Actually, we can do searches on this too. I don't see the little search engine, do you?
You do control it.
Control F, you can always do that. Yeah. You can do Control F and type in income taxes, and maybe I'm going to have to. Oh, there it is. All right. So here's their taxes: federal, state, and local. Right? But then there's their deferred taxes. Here's the part that's really cool. There's the statutory rate. Everybody's supposed to pay 35%. See it? And then state and local income taxes are 3.8. In their case, was 3.6. Then there's this non-deductible acquisition-related items. I'd have left that out of there. That's the piece I left out. And what I said was, and then the other looks like it's about the same every time. So I don't know. I think this is probably around 38.3 instead of 39.2. So that's what I used. Maybe I used 38.2. Make sense? So if let's say this had been a really big number, then you'd want to look at it. You know, are we always going to have acquisition-related stuff? Nah, probably not. Okay, so this was.
So you're just not putting that in there because the other 2 years
It didn't have it, and also it's acquisition. So unless they're planning to do it every year consistently, right, it won't be there. Right? So, and it might go the other direction too. Sometimes you see them bouncing around, increasing your taxes, reducing your taxes, timing differences. Right? So you want normal. So it looks like their normal's around 38%. Okay, not 39 really. Okay. So anyway, just wanted to show you that. So is there anything else we need? I don't think so. You? Let's see if we can find our way back without killing the whole thing. Those all tabs. That's scary, isn't it? Oh, there it is. Okay. All right. So let's calculate it. Let's plug them in here. And this is just so easy. What do you What do you want to do? What do you want to do for your weights? Let's start there. We'll start at the bottom and work our way back up. What do we find? What was market cap? When we did it the other day, what was your market cap?
12.28 billion. So 12.8 billion.
Okay. 12,280 million, right? Yeah. What were the number of shares?
188.23 billion.
Okay, and what was the price? I wrote it in the wrong place, didn't I? What was the price?
65.23.
And the other day was?
65.23.
Okay.
It's like 64 today.
Okay, so if we take 65.23 times 188.23, do we get to 12,280?
Yeah.
I should have made it millions, I guess, so we make sure we stay, be careful with that, make sure you stay in the same base, of course. Same decimal places. So 12,280, we got made, don't we? So we're gonna use that for weights. So we got 12,280 here. It's 12,280,000,000. So you can leave it 12.28 if you want, but make sure you do your liabilities the same way then, right? What were the liabilities end of the year? Those were in millions, right? What was it?
6805, and then the year before.
Six. Okay, at year end it's 68 comma. Oh, six. Only six. No, yeah, six billion. My kid. It's not 68 billion. Okay, so it's 6,805,000,000. Okay, so those are both in millions. Or you could put 6.805 there, and you could put 12.28, obviously, in the other one, right? You get the same percentages. Add them together, you get your total assets at market value, don't you? How much is that? Is this clicking? Anybody that had a rough time with this? Is this clicking? Pretty easy? Yeah. How much is it?
19,085.
All right. This is 100% of itself, right? 100% of the market value. So divide 19,085 into 6,805, and what do you get? 35.66. That's what I got. And then the other one must be 64.34. Is that what it was? Just take 100 less than. Is that what we got? So now you got your weights, and you can plug those in up here. So it's going, right? All right. So the weight of the debt is 0.3566. We'll take that times the cost of the debt. We'll have that one made. Okay. The weight of the equity. 0.6434. You know what's funny about this is it seems like, God, this is just really simple. And we can make more and more complex models out of this, right, than we have, right? But the basic idea is it's pretty intuitive, isn't it? It's pretty simple, what we're doing, okay? So good, but it's real valuable. Most people on earth don't know this, okay? Only people who know what they're doing in finance and accounting, economics. Okay, so then what? Let's get KD. What would you do for KD? I want the interest rate times 1 minus the tax rate. What do we say our tax rate was? 30. You guys used 0.392. How many of you used 0.39? Okay, we use that. It's all right. You get your answers. I gave you credit for it anyway. Okay, so and I think it's right too because it's your judgment. 0.39, right? Probably mine's a little better than yours, don't you think? Because there's a one-time hit in there. Yeah, probably. 38 is probably a little better. Okay, my judgment's better than yours. See, that's amazing. It's going to be 65 soon, right? Yeah. And how old are you guys? Yeah, so anyway. What are we going to do for the interest rate? Interest expense divided by the average debt? What's the interest expense we just looked up?
138.
Okay, and we've already got the ending debt. We know that it's 6,805, don't we? So it's 6,805 plus the beginning debt divided by 2. What's the beginning debt? 6,494. Of course, add them together and divide by 2. Everybody can see that real well. 6,805 plus 64, whatever it was, divided by 2. What did you get?
6649.5.
So 6650, something like that. It's your average debt, right? Divided into 138, you get your interest rate, won't you? That's it. What's the percentage? And this is before tax, of course. How much is that? It's real low.
0.0808.
So
2.08%.
2.08%. Yeah, it's the decimal in the right place again. 2.08. Is their interest really that low? No, it's not. We just looked at their note, didn't we, on debt? They have higher interest rates than that. Their lowest one's down there. Why did this happen? Because we have a whole bunch of non-interest bearing debt in there. How much was interest bearing? Remember, we looked at that number, it wasn't very much, was it? 3131? And the total debt is 6805, right? So at least half of it is non-interest bearing, a little more than half of it's non-interest bearing. So their rate's not 2%, it's what? It's not 2.1, it's 4.2 or 4.3. Does that sound about right? Yes. Because remember, they had a whole bunch that was only 2.8% interest, wasn't it? Right? Yeah. Everybody agree with that? It was huge. It was like $3 billion. It was their, they had a real low interest rate. Okay, anyway, so yeah. Anyway, you can look at this and see if your numbers make sense. You can just let yourself think about it. And then I'm going to take that times 39%, right? So 2.08. Boy, this is really easy to follow. Funny. Okay, and what's the deal? The government's going to pick up 39% of it, right? Because I'm going to put that interest, that $138 million on my tax return, and the government's going to pay 39% of that interest, aren't they? Right? Like all my expenses. Okay, so how much is my after-tax cost of interest? It's really low.
1.26%.
Okay, 1.26%. That's it. And I saw some strange percentages you guys got, so if you can show me where you got that, I guess do something with it maybe. All right, let's do KE. What's risk-free? What did we look up? The 30-year Treasury bond, what was it?
2.85%.
2.85%. Right? There's almost no expected inflation. That's what's going on. Okay? What was the beta of this company? What was it?
0.91.
0.91. What does that mean? They have less 909. What was it? Carried point
I think it was like 913. It was 913 something.
9135 or
Yeah, 9135.
something. Yeah, okay. So you can use more if you want. That won't make much difference. Okay. What does that mean? Beta of 1, you'd be the same riskiness, the same variability of returns as the market, right? Okay, correlation of 1.0. Right? So what is this? They have less variability, less risk. We think less risk. Okay. And then what's the risk premium going to be?
Market.
Yeah, what was the return on the market I gave you? What's the risk free? We just did it, 2.85. So 10% minus 2.85% is the risk premium. How much is that? 7.15. That's it. So you multiply 7.15 times 0.9135 and you add it to 2.85, and you're going to get something, what? A little bit less than 10%, because the beta is a little less than 1. That's it. So if you get this down intuitively, it's just no big deal. How much is that? Did you get for your cap-in?
9.36.
Yeah, I got 9.38.
So is
That's because my tax rate was a little
the-
different, right? 9.36%. 1 second. How much do you have to earn for the equity holders to keep them happy? 9.36%, right? What do you have to earn to keep the debt holders happy? 1.21%. No, I'm not kidding. It's true, right? Because the government's going to pay half, or pay 39% of the cost of the debt. So it's real low. Yes, sir.
How do you get that risk premium?
I gave it to you. I gave you the return on the market is 10,
Yeah.
and you looked up the 2.85. So all you had to do was subtract, and you got the risk premium. Okay. The return on the market less the risk free is the risk premium. Sometimes I'll give you this number. And how do we get that number? It's what you expect to happen forever out in the market. I think this number is really 12 to 13% forever, right? In there somewhere. But sometimes it's 15, sometimes it's 6, sometimes it's negative some years, right? But what do you expect the return on the market to be on an ongoing basis? I think it's there, but I also think the risk-free is kind of low right now. 3 is not normal. I think if there is such a thing as normal. I think this should be maybe 5 to 6%. And what would that give me for a risk premium? 12 less 5 is 7, 13 less 6 is 7. I think a normal risk premium is around 7. 5, 6, 7, 8, right? So right now, because we only have a 3% risk-free, we'll put it up here, because we only have a 3% risk-free, I says, well, maybe this is 10. So I gave you 10, right? You looked up the 3, 2.85, and that gave me a risk premium of 7. That's where it comes from. Or I could just give you the risk premium instead if I want. So when you're doing this in real life, you can do it either way, of course. You can guess the return on the market, or you can guess the risk premium. Personally, I think the risk premium is the better way to go, because I think it stays more constant, right, across markets.
How about the risk-free, where do we find that?
30-year treasury bond. Remember we looked up the treasury bond rate? I think you just got in here. We went out on Yahoo Finance, and we went to market data, or market, it's called.
Yeah.
You click on it, right, it's over on the left-hand column. Click on it, and then you go to bonds, click on bonds, and up it comes. It's the 30-year treasury bond.
Yield.
Yield, yes, the yield. First column there. So it's just what it's paying. That changes constantly, right? Okay, goes up and down. People, the numbers came in today, and the employment numbers weren't quite as high as people expected. There's always explanations people try to come up with, and that's why they think the interest rates are not going to go up now. I think we're not going to raise interest rates because the economy is firing up a lot. Okay, so what do we have now? If you know that 36% of your assets are financed with debt, which we think is the case, and we know that debt costs us 1.26%, which we think is the case after tax, you multiply those together. And if we know the equity is 64.34% of the assets, right? And that's going to cost us 9.36. We can multiply those together, we can add the two together, and get WACC. What is WACC? You did that. 6.4. Yeah, I had WACC 6.49. This came out 6.40, did it?
I don't know. That's right.
Okay, so who's got one that used these numbers?
I think 6.48.
6.48, I had 6.49. 6.40 seems kind of low.
I got 6.4.
0.3566 times 1.26. Somebody do it. And somebody else do 0.6434 times 9.36. That together. You know what you're doing here.
Oh, 0.449.
6.449.
No, I only got the first one. That.
Come on, you guys. Nobody's doing it. Somebody's doing it.
I got 6.48. I did it earlier when we were talking.
Oh, with these numbers?
6 point,
Yeah.
what's that?
All right, 6.48. I got 6.49. Sounds right.
Yeah.
Okay. All right, good. All right, I'm pretty lenient on your math stuff when I created these things, so I think you did it right. Okay, estimated cash flows then. So it's now we've got our WACC. This is 6.48, and we are on our way, aren't we? Okay? So what's estimated cash flows? What was our normal income we said? We used the before tax income here, didn't we? For our normal income this time. It won't always be that, right? Okay? Because normal, what was it? Look it up, come on, you guys. You wrote it down. What's the number? I already know how to do this. Come on.
What's the question? Yeah, what did you ask?
What was the income before tax?
12.28 million, or 1 billion to 28 million.
Okay. All right, tax rate was 0.39 you guys used, right? So 61% of 1228.
Well, that's not right. 1228. Yeah, yeah.
Oh, that's after tax. That is not that's fine. Oh, that's the whole answer. So what was before?
It was still 11.
Income before tax, what was the number?
1185.
1185, that sounds right. Okay, and then you take that times 61%, right? 1 minus the 39% tax rate. Everybody staying with me? Mind you guys. And then we're going to add back the depreciation. What was the depreciation? Yeah. I don't know why I'm not looking at my numbers. I have it sitting right here next to me. Oh, well. All right, guys. So then you add 508 to it. And what number did you get when you got done?
1230.
I got 1233.2. What'd you guys get?
12:30.
So somewhere in there. This one works out to 1230. Okay, there's our estimate in millions. okay? And now we have 1230 here, and I mean, this is nothing now. All you do is you take your 1230, right? And divide it by 0.0648, your whack. And what'd you get for your estimated market value of your assets?
You got 19 billion. Well, this is gonna be a little bit different because that 1228.
I got 19004.
I got 19,187.
What's this one?
18,981.
Yeah, they're all right around the same, right? So using 1230 and 6.48 is 18,931, you say?
81.
Okay, so it's about the same. Okay, that's 18.9 billion. What were estimated liabilities again? We already had it, right? What was our estimated liabilities we had? It's 6805. Use the same one. So after you do this a few times, it's easy. It just falls in place. But I think you have to really understand what you're doing. You can't just get it mechanically. 18,981 less 6805 is what?
12176.
Okay, how many outstanding shares are there? Well, how many outstanding shares do we have, everybody?
18823.
When we calculated it, we said there were 18823 million, right? We looked it up. All right. I'll put it up here. So divide 188.23 into 12 billion, or 12,176 million. What do you get? What kind of a price do we get on it?
64.69.
64.69. Yeah, I said 64.81. Okay. All right. Now, for some reason, then the growth kind of went crazy on some of you guys. It's close to nothing, right? How come I know it's close to nothing? The market price is 64.34, and this is 64.69. They're real close to the same number. Do you expect this to be positive growth or negative growth in cash flows? Seeing as the market thinks it's worth more, it must be what? Positive growth. What if the market thought it was worth less? It's negative growth, right?
On the test, are you going to have us look up a company again?
Absolutely. It's nice practice. Get used to using financial statements too. Okay, so let's do the growth then. What's that going to look like? Let's do another page. What are we going to do to figure out how much growth there is? I am going to take the estimated cash flows again and divide it by WACC. That's how we got the estimated market value of the assets. And then we subtracted from that the estimated market value, the liabilities. And that gives me the estimated market value of the equity. So none of this is changing. We're just continuing with it. Except now what happens is I have growth. So what I really want to do is I want to increase this by the growth. Take it times 1 plus the growth, right? But I don't know what the growth is, so we'll make the math simpler and leave that piece out, okay? But here I'm going to subtract the growth because what I'm saying is, if I get the returns through growth, I don't have to earn them intuitively, right? Getting it from growth, I don't have to earn as much. Okay, so what do I know? What were my estimated cash flows we had? Give them to me again. What do we have back there? 1230, something like that? Okay, good. All right, what was my WACC? 6.40. What I don't know is growth, right? But I do know what the estimated market value of the assets is, but I want the market's estimate. What does the market think the assets are worth? Well, what does the market think the assets are worth? We already know. 19085. Well, that's the equity, 12280. I want the whole thing. So I'm going to take the 12280, which is the outstanding shares times the market price, right? That market cap. And I'm going to add the 6805 to it to get what the market thinks the assets are worth. It's 19085. Okay. So this is 19085. What were the liabilities anyway? We could have gone the other direction, right? This is 6805. So if you don't remember, you could do this. and add them, right, and go this way. What was the market value of the equity that the market thought it was?
12,270.
Yeah. Which is the market cap, which is the outstanding shares times the market value per share, right, guys? So you could go the other way and get to the 19. The 19 is what we need. So you just go straight to the assets we use for our weights, huh? It's faster. So this number, 19,085 times WACC minus growth, is 1230. It's true, right? Just doing the math. So take 1230 and divide it by 19,085, and you will find out what WACC minus growth is. What percentage is that? What's 1230 divided by 19,085?
6.44.
6.44%. What does that make growth, everybody? What's growth? 0.04%. And I got 03. A bunch of you got 01 for some reason. 0.01, I don't know how that happened.
I got less than that, but.
Did I give you credit anyway? Probably.
Yeah.
Nice guy that I am. Okay. But it might have been some glitch in your calculating.
Yeah. My WAC was like 6.44, and
Yeah, I did that.
my growth was,
Yeah.
or not, like the whole thing was.
So then you get 0, don't you?
Yeah, I got like 6.435, so it was like 0.40.
Yeah. Okay. All right. Okay, so then let's do this if we wanted it. The last one was, what if there's a 1% growth? What would happen? 1% for, well, it's going to be worth more, right, guys? It's going to be worth more than this. So what we do is we take the estimated cash flows, same ones, 1230. But this time I'm going to take it times 1 plus the growth rate because I want to know what the next year is going to be. That's all that is. Okay, move it forward 1 year. Okay, so it's what's next year's times 1.01, I guess, huh? Right? And then I'm going to divide that by what? WACC minus growth. Right? Same rationale as here. Okay? So what do we have? 6.48, I guess we had. Less what? 1.0. All right? So what I've got now, what is 1230 times 1.01? We're adding 12.3 to it. 1.230. 1230 million times 1.01. Yeah, 1.01 is what?
1242.3.
Yeah. That's it, isn't it? Okay? Because we're adding 1230 to it. Okay? Divided by 5.48%. Right? 6.48 less the one that we're going to get from growth. This is my estimated market value for my assets. How much is that? Maybe a bigger number. Obviously.
22,670.
Makes the assets worth about $3 billion more. See that? 3.6 billion. Subtract the estimated market value of the liabilities. How much is that? Same number, 6,805.
15,865.
So this is my estimated market value with 1% growth, right? We got 1% growth here. Okay. Okay. How much was that? 865. Estimated market value. The equity. And guess what we're going to do? Find the outstanding shares in. The outstanding shares were how many?
88.3.
Million shares. These are all in millions. And that's going to give me my market value per share with a 1% growth, right? It's my estimate with a 1% growth. How much is that?
84.28.
Okay? And I got 84.40. What'd you get?
85, 87.
Yeah, okay. That's because your WACC was less. Okay? So you can see little changes in what your assumptions really move things around. Okay? Yeah. Could you do this now, guys? Big deal? Better do some present value problems. Take a while on that, but maybe that's worthwhile. Because some folks have a rough time, right? So something went haywire, something went wrong, right? Or you just weren't ready. How could that ever happen? wanna do some of the ones from chapter 6? 4 and 5 is kind of just, go back through and look at all those terms, and make sure you got them all. You guys weren't very good at determining what kind of an asset or what kind of a liability things were, right? How you valued them. We didn't really have that wired. But you just read the chapter and think you know it. It never worked. I have total confidence. I'm 6 to 4 to 5. Presidents, yeah, sure. Which ones you want to do?
13 or 14 or 15 and 16.
13, 14, 15, 16. Okay. Perfect. Okay. 13 says find the present value. This is from the chapter 6 quiz for folks at home. Find the present value of an investment in plant and equipment if it is expected to provide annual earnings of $35,000 for 18 years. Okay, so what's annual earnings going to be? And then the earnings are at the end of the period. So what is it? End of period. I think it's an annuity payment. It's always the same. The interest rate's staying the same. But what kind? Ordinary or due? Critical. The end of the period. Ordinary. It's an ordinary annuity payment. My guys. Okay, how much was it? 30,000. The end of each year. Okay. What's the number of periods? 18. True? How often are they compounding though? Oh, it's always compounded just once a year, so it's annual, so we have to, yes.
That's 30,000, not 35.
Yeah, do you take the resale?
The resale's 30 at the end, it's 35, thank you. Way to read your own prop. Yeah, it's 35. So I got an annuity of 35,000, don't I, for 18 years, okay? Number of years is 18, is that right? And then what's the interest rate?
15%.
Okay. What do you want me to calculate, by the way? Find the present value of it. Oh. Now, some of you just did that and stopped, didn't you? No, there's 2 of them. What else do you have to add to it? I have a lump sum, right? I have a future value of a sum. How many periods from now? 18. Still 18. How much is that? 30,000. Some of you told me that's worth 30,000 right now. I want to do business with you. You think 30,000 18 years from now, discounted at 15% is 30,000 now. Boy, I'd turn you into a money machine, huh? Right? You're indifferent. So you give me 30,000 now, I'll give you 30,000 back in 18 years, okay? Yeah, you don't want that. All right, so just relax, think about the thing. End, of course, is 18. Interest rate is still 15%. And I want to know the present value of that. And if I knew it, guess what I could do? I could add these 2 together and get my total present value, couldn't I? That's what the deal is, right? I'm getting this money, and so it's not 30, but it's also not nothing, right? It's got some value. So what do you want to do? You take this 35,000 annuity payment times the factor for what? Present value of an ordinary annuity, right? So this is an annuity payment, ordinary annuity payment. And it's just reading the problems really carefully. I know you guys know how to calculate these things, but it's reading carefully and seeing what the deal is. What's the business deal? It's not 35,000 once, it's 35,000 how many times? 18. What's 18 payments times 35,000? You don't have to do this, but I think it helps. Because the present value is going to be something less than that, but it's not going to be a little tiny number. This is a lot of money. What's 18 payments times 35,000?
630,000.
Yeah. So it's certainly not going to be more than 630. An interest rate of 15% is real high. So it's going to be, a lot less than that, right? But it gives you a gauge of where you're going to be. I want a factor for the present value of an ordinary annuity, right? Because I'm calculating the present value, not the future value, right? That's why I'm on a present value table. Number of periods? 18. Interest rate? 15%, right? So what is that factor if you look it up? Or you can use your calculator to do it. Just tell it the payments are at the end of the period. Careful on that one, right? The interest rate is what it is, and the payment's what it is, and the number of periods is what it is. What is that factor? You look up the factor. 6.12797. Really? Is that all it is? 18 periods, 15%? Why is it such a small number? It's 15% interest. It's big, right? Would you like to earn 15% interest over your lifetime? Nice, for a number of years we did. Right, and then the bottom fell off, it must have the market value, so I guess we didn't really earn it. Yeah, but we haven't earned 12, 13, a long time. Okay, so we don't take the 630 times, it takes the 35 times it, right? Because what that represents is what? 18 $1 payments, right? All discounted back to now are worth $6.13, okay? But I don't just get $1, I get $35,000 18 times. So what's the whole 630 worth? 35,000 times 6.1279 is how much?
214,471.
Excellent. Okay, so that's that one. Now this isn't worth much, is it? We're going to take that $30,000, which is a future value of sum, future value 18 periods from now, and we are going to discount that, take it times 1 over 1.15, 15% interest for 18 periods, and we're going to get the present value at times 0. And what this is a present value of a sum factor, right? Where the interest rate is 15%, and the number of periods is 18. Okay? What is that factor? What's 1 over 1.15 raised to the 18th, in other words? You look at the table, that's what they're giving you, right? Present value of sum. The trick is to get on the right table, isn't it? Present value of sum is what? This isn't going to be worth very much. It's a lot of interest and a lot of periods. What is that dollar worth?
0.08081.
0.8081. It's worth 8 cents. If you invest 8 cents at 15% interest for 18 years, you will have $1. Right? Nice, huh? Okay. So anyway, 30,000 times 0.08081 is what the whole 30,000 is worth. Each dollar is worth 8 cents. How much is that? All that's worth. Add the two together, 214,479 and 2424, 216,903. Yeah. How could anybody miss that? I know. You want to get one. Okay. All right. 14. Market price of a 240 10-year 10% semi-annual. That's only 5% though. Every 6 months, right? Bond is still the yield effective rate of 12, but we're going to discount it to 6 because it's semi-annual. And how many years is it? 10 years. How many semi-annual periods? 20. Okay, so what we do is we say, I have a future value of a sum. When am I going to get paid off on this $240,000 bond? At the end of 20 periods. Not 10 periods, it's 20 because it's semi-annual. What if it was quarterly? It'd be 40 periods, right guys? So it's 20 periods is 240,000. What else is in this bond? What do we know? There's also an ordinary annuity payment, am I right? But I'm getting 20 times. What's the interest going to be? 10%, but it's semi-annual, so it's really 5%. What's 10% of 24,000 a year or 240,000? It's 24,000, right? Cut it in half, it's 12, isn't it? 12,000 every 6 months. Everybody agree with that? But how many payments are there? There are 20 of them. So how much money is this really I'm going to be valuing? It's 240,000, isn't it? This thing is going to pay back 480,000 no matter what we pay for it. Am I right? 240 in interest and 240 in principal. That's the deal. 480,000 cash flow coming in the future. True? What's the interest rate in both cases? Be careful. Sold to yield 12%, right? What's that for 6 months? 6% every 6 months. There's 26-month periods. Half the interest rate. Double the periods, half the rate. Right, guys? Okay, 6%. Number of periods, of course, is 20. And I'd like to know its present value again. Here we go. Good deal? If I knew the two present values, I could add them up. I know the total value of the bond. This looks just like the last problem, doesn't it? That's because it's exactly the same thing. Wow. Just cash flows, one's a lump sum, one's an annuity. Okay? All right. So what do I want to look up? Get this, you can get the lump sum first if you want. Future value 26-month periods from now is 240,000. I'm going to take that times 1 over 1 plus the interest rate, which is 1.06. I'm going to raise that to 20 times. That's not worth very much, is it? That's the present value of a sum factor for interest rate 6%, number of periods 20. What's that factor? What's a dollar worth? Receive 20 periods from now, discounted at 6%. What'd you get? 6% is not 15, is it? It's worth a lot more, even though it's 20 periods. How much is that? Compared to the last problem. It's not 8 cents, is it? A little more. What is that factor? Come on, you guys. Come on. 6%, 20 periods. Present value of sum. Anybody see it? Anybody looking? Somebody help me.
I got 74,833.
You get what? 104?
74.
74.
Yeah, 74,833.
What was the factor? Anybody look up the factor? You got a table there. What's the factor? 80. So what's worth 31 cents? $1. Received 20 periods from now, 26-month periods. Discounted at 6% per period, right? By the way, you think this thing's going to sell at a discount or a premium? You should have said that earlier. You know, it pays 10, the market demands 12. Who wants this thing? Nobody. What are they going to do? Bid the price down. You have to lower the price to sell it. To issue it. It's going to go at a discount. It's going to go for less than 240,000. I know the present value is less than 240. Don't you guys? So was that 74,833? Did everybody agree with it? We don't trust foreigners, right? So, calculate. It's money. Come on. It's not politically correct. Yeah. Just because he speaks 5 languages doesn't mean that he's superior to us or in any way. Right, Mohammed?
What?
Never mind. All right. My problem is I don't speak English, so he doesn't understand me. Yeah. Okay, anyway. So, what is the value of this thing? You're going to take 12,000, which is the annuity payment, right, guys? It's an ordinary annuity payment. And we're really valuing 240,000 because there's 20 payments, of course. And I'm going to take that times the factor for n equals 20, number of periods is 20, interest rate equals 6%, and this is a present value of an ordinary annuity because I got an ordinary annuity and I want to know its present value. After a while, it's ridiculous to say this stuff. And then that's going to be what? Present value times 0, so is that one. Present value times 0, isn't it? Okay, so what is that factor? 20 periods, 6%. Present value of an ordinary annuity. What factor did you get?
7.46.
What's that? What's worth $11.47? 20 bucks is. Received $1 at the end of 6 periods, 6 months rather, $1 at the end of the year, $1 at the end of 18 months. Keep going. Every 6 months. 20 times, right, over the 10 years. And so what we're looking at is what $20 is worth. It's worth $11.47. What's the rest? What's the $9.50? It's the interest, right? Up here when it's worth 31 cents. What's the difference between $1 and 31 cents? It's 69 cents of interest. We're just taking the interest out. So 12,000 times 11.46992 will be what the whole 240,000 of interest is worth right now. How much is that?
137,639.
And then what do you want to do? Add the two together. You got it. What's 74,833 plus 137,639?
212,472.
That's it. Got it. Same problem as the last one. That's really annoying, isn't it? Especially if you got one and you didn't get the other one. Got two. All right, let's do 50. On January 1st, 2014, they exchanged equipment for $160,000. Non-interest-bearing note. There's no such thing as a non-interest-bearing note. Everybody gets interest. What they did was they raised the price. Ever seen these furniture sales? No interest for a year. And give me a break. There is 2 interest for a year. They charge you more. Right? You calculate how much it is. Right? take the interest out of there. Of course, you have to estimate what the interest rate is. And by the way, they can borrow cheaper than you can, so works out to be a good deal for you and for them, so they don't mind. And then what they do is they say if you don't pay it at the end of the year, the full amount, right, then the interest rate goes to 18 or 24%. That's where they really make their money. You buy it, wait a year, now the furniture's getting old, can't sell it for anything, they owe all this money, they don't have the money, and they start paying interest on it for the rest of their life. That's the practice, really. So don't buy anything interest-free unless you have the cash. And if you do have the cash, you can keep it so you pay it at the end. If you do have the cash, just offer them 10% less. You know what they'll do? They'll take it. Okay. Then we'll sell it to you. They'll tell you you're crazy at first, but then they'll take it. On January 1st, 2014, Uval Company exchanged equipment for 160. Okay, so what is that thing? The note is going to be when? It should have been 2015, isn't it? Which is how long? 1 year? Is that right? It's just 1 year, and prevailing interest rate on this type of note was 6%. The amount of interest revenue should be included in their income statement. What do? Okay, I'm going to debit note receivable and credit sales, aren't I? Or credit equipment, and debit accumulated depreciation, have a gain or loss, I don't know. I mean, if I'm business selling equipment, it's sales. So it doesn't make any difference. What's the note receivable? How much is the note receivable? It's $160,000 discounted for how long? There's only going to be 1 year, is it? So what's the $160,000 non-interest bearing note worth? What would you do? This is a future value 1 year from now, is it? It's 1 year, isn't it? The problem said 14 back to 13 years. It should be 14 to 15. What's the interest rate? 6%? How many number of periods is it? 1? What's its present value? Wow, it can't be that easy, can it? Divide 1.06 into 160, and what'd you get? That's what the note's worth. The rest is interest. How much is the note worth? 943 or 944 or something like that. That's it, huh? So what happens? At the end, how much are they going to pay you? I have a note receivable of that much. I'm going to debit. Let's say I'm selling this. I'm an equipment dealer, so it's sales. Make it simple. So I don't know what the book value is of the equipment I'm selling, like the one I used. This would be 150, 943 on the date of the sale. What would it be 1 year later? How much cash are they giving me? 160,000. How much note receivable are they paying off? 150, 943. Oh. What's this? Interest revenue. 9056. That's what I got. 9057, something like that. Easy, huh? Maybe you got this. It's only 1 year. There's no such thing as an interest
There's 2014 in there, 2013, and 2015, so that confused me.
I know, and then but I told the class, which you're in the middle of a quiz when I told the class I had a typo. Yeah, that would really sort it out.
I did it for 2 periods, so I got it wrong.
Oh. Well, the 16's not there, is it? Yeah, I apologize. But you knew what you're doing and got it wrong? That's terrible. Okay. Is that going all right? Did you do it? It would have been a harder problem for 2 periods. It's really unfortunate.
Can you go back a little bit?
So what you did, you took 1 over 1.06 squared, got a smaller number. You got a smaller number, right? And then you took that times .06, and that would have been your interest for the first year, right? If you thought the thing ended at 16, and it's asking you for 15. So you would have had less interest than $9,000, obviously. If you have 6 or something, 5. Not gonna tell. Okay.
Do it.
What interest did you get for the year you went?
Well, I wrote down the present value, I didn't put the interest
Oh,
expense, so that's probably why I got it wrong.
oh, all right, okay.
But I did it for 2 periods, which wasn't on the right road from the beginning.
I use the future value, future value of the sum, 6% at one period.
Yeah, but they're not gonna give you 6% interest on it, it's not interest bearing. They're gonna give you no interest, they're just gonna pay you the $160,000. So what you do is you figure out what the 160 is worth right now, by taking 6% interest out of it. Right, so what I did was I said, okay, I am going to receive 160,000 1 year from now. Right, at least that's what I meant to say, right? 6% interest 1 period. So what do I have? It's only worth 151,000 right now. So when they pay me the 160, I get my 151,000 back plus 9,000 of interest. Right? So my note when I record it is 151,000. When they pay me, I'd still take out the 151,000 when I record the cash. The rest must be the interest revenue. You know, the discounted present value of the note right now is about 151,000. Another way you can do it is you can take 151,000. Try this. Take 150,943 times 0.06. What do you get? What's 150,943 times 0.06?
1,056.58.
Ta-da. See it? So all we did was we discounted and then we compounded, right? It's like you're doing a bond or something. Okay? That work? All right. On December 30th, 2014, Hayes, 16. Okay. There you go. Hayes purchased a machine from bank in exchange for a non-interest bearing note. Here's another one requiring 8 payments of $45,000. First payment's made on December 30th, 2014. Right at the beginning, this is a what kind of payment?
Annuity due.
Annuity due. You got it. And we have it made now. Of course, the first payment's going to be worth $45,000, right? It's right now. Okay? Each one's worth less. Okay, so it's $45,000. How many are there of them? 8. Sure, that's just 45,000. 8 payments. How much is 8 payments times 45,000? 90 times 4, 360 is what that is. So I'm valuing $360,000 when I do this, right? Okay, so the first payment is made at the beginning, the other are all due annually on December 30th. At the date of issuance, the prevailing interest rate is 11%. So N equals 8, interest rate equals 11%. What do I want to know? I want to know its present value at the date of issuance. That's kind of interesting, isn't it? Let's do that. Let's get the present value times 0. What is it? It'd be 45,000 annuity due payment. Times the factor for an annuity due payment, and I want the present value times 0, right? So the present value for an annuity due payment, okay? Interest rate, 11%. Number of periods, 8. What factor is that thing? What are those 8 payments worth right now? On the annuity due table, right? It's the beginning of the period. How much is that?
5.7122.
Take that times 45,000, what do you get?
257,049.
But that's not the answer, why not? Didn't ask for what the present value of the annuity is, but it asked for. What's are gonna be in December 31st, 2014 on the balance sheet. What's gonna happen here? What do you think? They purchased a machine, it's gonna be debit equipment or machinery, whatever, for $257,049. What are you gonna credit? Cash, how much? The first payment, 45,000. Oh, the principal goes down immediately. And then what's the rest? Note payable of 212,049. That's what it asked for. Got it? What's another way you could have done it? I'm just valuing 7 payments. Oh, right? What if I change it to 7 payments? I'll get 212,049. Because one payment already came in. Right? But when are the payments going to be? It's at the end. It's an ordinary annuity payment now. So if you do that, be careful. Now it's an ordinary annuity payment. What is the factor for an ordinary annuity payment? 11%, 7 periods. Factor is that?
5.1461, or no,
4.7112. 2. Take that times 45,000. What do you get? 212. Yeah, within a dollar. Round. You like it? You play with these long enough, and they start making sense, don't they? You see how this might be really a valuable skill for you guys to have. You know, it drives you crazy, doesn't it? Learning it. Yes, you can do it. It's very frustrating. Because you think you know what you're doing, and you look at these, you know, I wrote these things so they're, you know, a sentence long, and everything's just staying right there. You know, you just take it and calculate it, and it still goes crazy after that. Working. Keep thinking. Could I make these problems, each one, 3 times as long? Yeah, but what would you still do? Do I want a present value? Do I want a future value? What are the number of periods? What's the interest rate? And is there an annuity payment? And if there is an annuity payment, is it the beginning or the end? Boom. That's it. You figure the pieces that's missing. The piece that's missing is what I'm calculating, of course, right? The ones they gave me is, they gave me. So, what time is it? Supposed to start class, right? No, 4:30. Gonna happen.
Can you do number 5?
Maybe we ran out of time. Maybe it's hoping we ran out of time. Dressed up again today. Another meeting. We've got a lot of people. This group is really cool though. We're doing savings accounts for poor kids. Louisville's a mess. Like most cities are, but we have unique problems for Louisville too. The poor people in this city are really concentrated on the west side neighborhoods, not very far from here, and then down south, the freeway too. And some of the grade schools, 99% of the kids have free lunch program. 99%. Yeah, it's unbelievable. You know, so you know what they're going to do is they're going to do savings accounts for kids. We're going to raise money, we think, and how hard we're playing this. And we're debating whether we're going to give the kids $5 or $50. Some states, some cities around the country have already done this. And some of them did $500. $500 if you gave a kindergartner $500 and got them saving for college, and you might have a strong possibility of going to college. But the reality is, you know, that's future value stuff. 500 is not enough, is it? 500 from the time they're in kindergarten to when they go to college. But really what it does is it gets them thinking about college. So what we might do is $5 and do every poor kid in Louisville, give them all a $5 savings account. But at the same time, talk about saving, talk about future, talk about, gee, you could go to college. How many of your parents didn't tell you, how many of your parents did not tell you that you were going to college? I'm old. My dad says, you guys are going to college. I don't care what else you do, but you're going to college. All my kids are going to college. That was like when I was 3 or 60 years ago. I was doing that, right? So what if we did that with all the poor folks? Got them going, got them going. We can't give them the money. But you know what? There's all sorts of scholarship funds. There's all sorts of grants. There's all sorts of aid, you know. And also, what happens if you invest your money? What if I had been really smart and when I was 23 years old, I took 10% of my income and invested it? I started putting 10 to 15% of my income in when I was 22 and I started working instead of waiting until I was 30. I would have double the wealth for having done that during that period of time. Wow. How stupid that was, huh? But you guys know, don't you? Here's this last problem on this thing. Know what it looks like, huh? What happens to those dollars you're putting for the first 10 years? Oh, man. Oh, man. By the way, is it hard to put it in? You'd really like to have a nice car instead you're going to drive not so nice a car. You'd really like to buy a big fancy house instead you're just going to have, you know, a normal person's house for a while. But then what happens when you're about 45 years old? You can either retire or you can buy your $1 million house, right? Whichever way you want to go. Drive in a $200,000 car. Not kidding. You guys can do that, right? My personal preference would be to retire. Do something about that. Yeah. All right. Which problem number do you want to do? 5. Anyway, it's very uplifting. Okay, Harley, huh? Not spelled right. Decided to begin accumulating a fund for asset replacement 5 years from now. I don't know about you guys, but I think n equals 5. Okay, unless it's compounding more often. Anyway, it's going to make 5 annual deposits. I think that is an annuity payment. What do you think? And it's going to be $30,000. Is it due or ordinary? Oh, I is 10%. Is it due or ordinary? It's begin on January 1st, 2014, and this is January 1st, 2014. What kind of an annuity is it? Annuity due. It's an annuity due payment. Fantastic. Got to know that. What will be the balance of the fund? Now this one's going to grow. So what do I want to know? A present value or a future value? I want to know its future value. When? The end of 5 years. That's it. Okay? So what I'm going to do is I'm going to take my $30,000, that annuity due payment, and I'm going to have it grow into the future, right? So that annuity due payment is going to grow to some future value 5 periods from now. And what I need is an annuity due, the future value of an annuity due, right? What's the interest rate again? You don't have to write all this down, of course. I know what it is. 10%. Number of periods is 5. So we go look up that factor. What's the factor? What will $5 grow to? It's $1 5 times, right? Deposit at the beginning of each period for 5 periods. That's what we're looking for. So go to an annuity due, future value annuity due table. 5 periods, 10%. What do you get?
We don't have that table.
Oh, darn. You don't have that table. What you have is what? Future value of an ordinary annuity, and what's that missing? One interest payment, or one interest accumulation for each period, right? The payments are at the end. So what's the factor for the future value of an ordinary annuity?
6.10519.
And this is interest rate 10%. Number of periods equals 5. It's how much?
6.10519.
6.10510. Okay, so that would grow to $6.10, right? $6.11. The $5 would, right? Compounding at 10% interest for the 5 periods. But we get one more period's interest on every single one of them, right? Because every payment would come in 1 period earlier. So couldn't you just take that times 1.10, 1 plus the interest rate, right? And what do you get? It's that factor. That's it. What's another way you could get this factor? add a period, go down to 6 periods, right?
Can you
The
just,
same table, go down to 6 periods and subtract a 1 from it, right, because 1's the first one. So now I've got year 2, 3, 4, 5, 6 from that table, which are the periods I want, right, because my interest is at the end. So if you go down 1, what's the factor? Is it 7.71561? Go 1 more period down. On the future value,
7.71561.
yeah, now take 1 away from that, what do you got?
6.7.
It's a miracle. So either way's fine, that's a little shortcut.
Then you just use the annuity, the ordinary annuity factor, and then just multiply your end result by 0.1.
Yeah, sure. Instead of multiplying the factor times it, you could do the end result times it. Either one, okay? That works just fine. So you put 6.71561. So you don't even have to have all the tables. Doesn't matter, right? Know what you're doing. You're adding a period's interest. Big deal. What if you had the future value factor and you wanted the present value? Divide in, right? Divide into it and take it down. You can do the same thing with the present value tables, ordinary and due, right? Yeah, they're related to each other. Okay, anyway. So what's 30,000 times 6.71561?
201,468.
So Keith's a really mean guy making you do this kind of stuff, huh? That's valuable. It's really good. You're gonna be good at it. Okay. You guys are gonna be scary. There's a reason the CPA firms come here and hire first. There's a reason. You guys know what you're doing. Want to do another one? 12. Okay. January 15th, 2014, they adopted a plan to accumulate funds for environmental improvements beginning July 1st, 2018. Estimated cost of $4 million. They're planning to make annual deposits of $782,779 in a fund that will earn interest at 10%. First deposits, that's the key thing. July 1st, 2014 is the first deposit. So, and we're going to want to know what it grows to when. How long do we have? To July 1st, 2018. Yes, that's when we're going to do it. So, all right, so we've got an annuity payment. Everybody agree with that? The annuity payment is $782,779, isn't it? Is it ordinary or due? What could we call that thing, probably? That's probably due, right? It's at the beginning, isn't it? I think it's a due also. What's their interest rate? What's their number of periods? Wait a minute, they need $4 million estimated cost. So where do you think it is 5? I should wrote this problem. I did.
That's what you're trying to calculate, isn't it?
I'm trying to do, yeah, where'd you get 5? They gave you too much information here. It's terrible. Turned this into a really easy problem, didn't I? What I wanted you to do is calculate how many payments they needed to get that amount of money. I should not have given you the July 1st, 2018 date. 2018 is how many periods out? 2014, 14, 15, 16, 17, 18. No, that's 5, isn't it? It's 5 periods. So I guess you could have made 5 deposits, couldn't you? By then. Okay. It's going to be 4, I guess. So this is what we're calculating. This is what we're calculating. We don't know that. What we do know is the annuity due payment. We know the interest rate, and what else do we know? We know the future value when. How many years from now? 5 years out. Is that right? That's how much we want to have. Maybe this was really hard when I calculated it. How much is this supposed to be? $4 million, right? We do have So what would we do with this thing if we didn't know the number of periods? If we did know the future value, we did not know the number of periods, we knew the interest rate, and we knew the annuity due payment, what would we do?
On the factor,
Find the factor. So my annuity due payment is 782 to 779 is what I meant for you to do, times a factor, right, to give me a future value 5 periods from now. Actually, the future value in periods from now. I don't know the number of periods. I should not have known the number of periods. Okay, and then this would be interest rate equals 10%. Number of periods I don't know. That's what I was after. Okay, so I'm looking for that number of periods. And what kind of a factor is this? Future value and annuity due factor. What is that factor?
we don't have it.
Okay, but this is 4 million. So what do? Divide it. That's what I wanted you to do. So 782, 779, and 4 million is what? 5.11. Okay. So what do? Now? You go to a future value of an annuity due table. Okay, for interest rate 10%, and go down until you find that 5.11, and that gave you about 4.
Well, we don't have that table, so you have to use the ordinary.
Ah, even worse, you have to go to the ordinary annuity table. But what you could do is you could add a period to it, right? Deduct 1, so you go down in the 10% column until you get to what? 6.11. So go down until you get to 6.11. This really was hard. Except that I gave you 4 years. 6.11. What do you get? How many periods is that? Is that 4? 4.70. Because we have one more period, right? Okay, so it's 4 point.
Yeah, I rounded it up to 5.
It rounds up to 5, but then you have to subtract 1 from it. So, yeah, that problem's awful. It's not written right. I apologize. Did somebody else's problem and rewrote it. Didn't really rewrite it all the way. So that's awful. How many points was that? 1 point? Oh well. Did they make you turn your brain inside out? How'd you get 4? Or just misinterpreting the problem?
I just,
Or you just approximate what it must
yeah,
have been?
it's approximate, so if you go, it goes from 4.64 to 6.105,
Yeah.
it's
So
it's closer to 4,
interpolating,
so I was
it's
just like,
around 4.
I was
Yeah.
gonna say like 4.5 deposits, I was just saying.
Yeah. So you're still looking for that factor, but I didn't give you that table. At least I could have done is made it an ordinary annuity, and it would have been easier. Yeah, that's what I intended. So, number you got it right though. Probably just looked at 782 compared to that and it's 5, and it couldn't possibly be 5, right? There's no interest, almost no interest. Got to be 4. Couldn't be 3 probably. Too much. I guess you could use common sense and get it. It's kind of obnoxious. You want to try another one?
Right, we get the last one.
Okay. If you assumed on the last problem, let's assume you got this answer. If you got part A at 5033, 289. So write that down. That's what the answer was for part A. So if you got that, what would you do for the rest of it? So what we had were ordinary annuities, didn't we? So we had invested, and then we left the money in, and then we had to keep compounding for the rest of the time until you retired, right? Then you added up each one of those annuities at their final future value, add them all up, and you get how much you have when you retire. And the amount you had when you retire is 5,033,289. Okay? And then it says, okay, you're 62, you decide to retire. Purchase an annuity for 30 years more than you think you're going to live until you're 92, but you're only going to earn 4%. So what do I have? I've turned this 5,033,289 into a what? Present value, right? Present value of sum at that date. It's a present value, I don't know how many years from now, 40? I got the idea? But you treat that as a present value. And then what you say is, okay, I'm gonna earn interest. I am gonna buy an annuity that earns interest at 4%. I wanna pull payments out of there for 30 years and have nothing left at the end, right? So how big an annuity can I buy for $5 million? What will it pay me every year if I earn 4% on what's still left in it, continuing, right? As it diminishes down. And it's for 30 years of payments. And when do I want my payments? At the beginning, right? Because you're retiring and you want the money out. Does that make sense? Everybody good? That's the beginning, right? So what I want is a annuity due payment. That's what I want. Okay? So there is some annuity due payment. There's some payment here. Some annuity due payment. I'm going to calculate it. That when I take that times appropriate factor, I will get my present value at times 0. What's it worth, in other words? Okay, well, my present value at times 0 is 5033289, or whatever your number was, right? Should have been that number. Okay, and what this is the present value of an annuity due. Factor. Interest rate, 4%. Number of periods, 30. What's that factor?
17.98371.
What's worth $18 here? $30 is. You need $1.30 times, and right now it's only worth 18. I mean, I buy $30, I'm going to receive in the future $1 at the end of each year for 30 years, and I only get $17.08 for it. Yes, because I'm going to earn interest of how much? $12. Is that right? Yeah. Even at 4% interest, it's going to be $12. A lot of years. Okay. So divide 17.98371 into 5033289. You get 279,880.
Yeah.
That's it. So your retirement's going to be $280,000. Sounds like a lot of money, but it won't. It's going to be inflation, right? I made $9,600 a year, January 1973. Started work. This year they're paying, what are the salaries this year? 53,000. That's about the same purchasing. Oh, how many years is that? 33 almost. 5 times as much. More than that. Get closer to 6. Got it?
What number it says?
So if you're starting at 50 now, what's it going to be 30 years from now? Yeah, maybe 250 to 300, depending on how much inflation you're expecting. Real low inflation, not that much. Real high inflation, a lot more. Right? I got a really, really nice car when I was about 21 years old for $3,500. It's crazy. It's a comparable car now. I don't know, 30 grand. Crazy because that's a college spot. But I had a wife that wanted stuff too. She was pretty too. And we go. Anyway, so. Anyway, easy. You guys can do this. Try another one. At 8 minutes. I'm not going to do part A of that.
We do number 11.
Actually, I did do this on one of the videos today. I think I wanted to hunt around. There's too many of them, aren't there? Principles, I gotta start getting rid of them. There's too many of them. Okay, 11. Hot company sold to say 500,000 at 10% bonds to yield 12%. Oh, Okay, so the future value of the lump sum is 500, right? They're 10% bonds. Interest is semi-annually, so the interest is going to be what? 50,000 a year or 25,000, right, guys? Every 6 months. It's paid semi-annually. And then what's for the 6 months of June 30th? That's the first 6 months. That's nice. How much is the interest? Oh man, you look at all that and you think, man, I really have to do a lot of calculation, and you realize, no, I don't. How much is the debt? Right? How much is the interest rate? The yield's 12%, but it's semi-annual, so what is it? What's that? I'm done. That was fun, isn't it? Is that the right number? Doing the math right? What did they do here? I love this. What did I do? All this work for one point anyway. This is not much work. What did I do? I discounted what? Let's do it, in fact. Let's see if they're right. Let's take our time to do that. Value the bond, and then calculate the interest. Value the bond, and then calculate the interest. Let's say I told you that there was a $500,000 bond. It's 10%. It's going to yield 12, but I don't give you the 354. What made this easy was I gave you the 354. Value it. Go ahead, do it real quick. What's the value of that bond? 500,000 at the end, plus 25,000 interest. How many times? How long term was on the bond? Let's say. Maybe it didn't say. Oh, I can't work it. That made it look hard. I didn't say how long it was, did I? Oh, well, let's, we can't. We'd have to have a nice calculator. Somebody that had a nice calculator or a computer, you can calculate what the number of periods was. We'd have to just sort of guess at what the periods were. Yeah, you can do it with your calculator. Yeah, probably. What you need to do is put in the value, but it's two, right? So it's present value of sum, and it's the present. I don't know if your calculator will do it or not, because it's got to do both of them at once.
Payment, future value, present value, interest.
Yeah, but you have both a present value or a future value of 500,000 at the end, and you also have an annuity, and the two of them have to add up to the total value of 354. Right, see what I mean? So the two of them add together. Present value of the sum at the end and the present value of the annuity add to 354. Maybe you can put both in. The annuity is 25,000. And we don't know the number of periods. That's what we're solving for. The problem is, can you put in an annuity and a lump sum both in one calculation? Okay. So, and your number of periods is how many, guys? We don't know. Interest rate is 6%.
So the payment is 25,000.
Yeah. And the payments are at the end.
Yeah. Future value is 500,000.
And then there's a future value of a lump sum too, of 500,000.
Oh, no.
Yeah. So it's two different calculations. You have to add them together.
Is it 2.97?
2.971.
Period.
I have no idea, but that doesn't sound right at all.
Not gonna do me.
It doesn't sound like it nearly enough. If it's a $500,000 bond, that's 354. It's 10% bond, 12%. We could try different ones. My guess is it's a 10-year bond, maybe. 20 periods. But you have to do both of them. So let's not do that. But anyway, all you had to do is take the present value times the interest rate. That's what the interest rate has to be, right, guys? So that's what the debt's recorded at. That was kind of